Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is October 4th, 2024. S&P 500 currently sitting at 5711. I'm David Zarling. I'm here with Ian Gamecock McMillan. First of all, Ian, what is a gamecock?
Fighting rooster. The cockfights.
Yeah. It sounds ferocious. Pretty
gruesome. It's like dog fighting, but with chickens.
Yeah.
Put like metal spurs on their legs so they scratch each other and cut each other open.
Yeah. So a pretty sinister mascot for the South Carolina team. And you guys have Ole Miss this weekend?
Ole Miss, the Rebels. I don't know if we're allowed to call them Rebels. I know that was the thing.
Yeah.
You know how...
Yep. You could be a fighting...
sports mascots.
Yep. It's kind of wild. And here we have S&P 500 unchanged week to week, but a little bit of price movement intra-week, but plenty to analyze here underneath the surface that's worth paying attention to.
Yeah. Came down and, tested this. I'll call it 5,700, just to use a round number, which were the highs from July and August. So talked about that for a few weeks. It's kind of your intermediate term line in the sand to use. And buyers so far come in where we need it.
And we have continued to see rising 200-day averages for many areas in U.S. markets. We've held these short-term levels that you just mentioned. We're seeing indices that are equally weighted. We talk about the S&P 500, and most think of it as being the cap-weighted big boy club where you have market capitalization. But when you look at it on an equally weighted basis, a nice range has been built at new highs for something like RSP, representing weight S&P 500. And so a quality characteristic. And we just recorded a positive month of September, which is bucking a seasonal trend. Most Septembers, whether it's election year or not, are negative for a market. And we had a positive one. And that's another box checked for the strength
especially
of this
that
market.
Second half. I think we got into earlier September. Definitely the first few days of September were wonky, right? So then, and I think I saw this, I'm wrong, but that September weakness usually comes in the second 2 weeks
Yes.
of the month.
Ryan Dietrich does good work on this.
On tippers, we were breaking to an all-time high. So,
yeah.
And we've held above there. Yeah, and I think there's been improvement under the surface. Still not a hard flip. I'm not saying yet, but it's clear for small caps and mid caps. But healthy. It's certainly this has not been a mega cap thing.
Correct. When you look at the last 3 months, tech has not led during that period. And so that means other things have had to carry this market higher. And when you combine that with a positive September, that's definitely information worth paying attention to. And here we are heading into one of the most volatile months of October, then sets us up for what is notoriously the strongest 6 months period, November through April. And so if you have a market that's resilient again in October, it does make you wonder how strong November through April could potentially be. With the caveat that seasonality is not a predictor. It's about what happens during that time frame matches or not match. You could go, we could be resilient into November, and then November through April are negative, and that would be
That would be concerning.
massive. Yeah, it would just be massive information. But we continue to have higher highs and higher lows and rising 200-day moving averages, and you have areas, even like China, that have been in massive downtrends.
So big week last week, that has not slowed down. Another very strong week. Now, when we look at a relative chart, especially a longer term relative chart, let's keep in mind that China has severely underperformed for over a decade. So it has been a nice move, short term, very intriguing. Absolutely would not be shocked if we, in 2 or 3 years are looking back on like, oh yeah, that was a big bull market for China. So 2 caveats to that come to my mind. Oh my gosh, are you missing out? I don't think you've missed out on anything in China yet.
Yeah, if this is
At
going to turn the
least not from a
corner,
relative perspective.
yeah, if this is going to turn the corner, it's going to take time. This will just be the initial phase. This will be watching the boat leave the harbor and somehow think that you've missed it. The whole journey ahead here that still has to play out.
Put this in perspective. Compared to U.S. stocks, China it's in a 15-foot hole, and we dug out maybe 1 or 2 feet over the last couple weeks. There's a long ways to go. It's definitely intriguing, but if you're sitting there thinking like, oh my gosh, I missed this, whatever they are, 2 weeks, they're up in a lot, 30%. If you look at FXI is up 43%
In 2 weeks.
in 2 weeks.
And prior to that, to paint the picture for our listeners, FXI versus S&P has been in a downtrend since October of 2007. At its depths was minus 90%. This move, this 40% move, did back to minus 87%. So while there is signs, there is plenty of work to do and plenty of opportunity if it were to continue.
And I think now you've had such a big move, Dave, that, for me, you kind of move into like, okay, now what are we doing for the next 6 months?
Right.
In China?
We are hitting some levels.
And you're going to have to work off some of this Thanksgiving food that they put in their belly.
Yeah.
It's big. You're going to have to work some of this off sideways, either through price or time somehow, if you want it to be a healthy long-term uptrend.
A barge does not turn like a sports car. And if China's going to turn around here, that's fine. It will just take time. And people shouldn't feel like, oh, I missed out, because
Did miss
frankly,
out. David Tepper's long, so you kind of missed out, I guess.
Yeah, I think you said it well before we hopped on to record that. Isn't it interesting now that we want David Tepper's opinion, and his opinion all of a sudden is about loading up on China? He's got a job to do too, and that's to create a market. And you just have to be careful because the networks that they're on don't have your best interest in mind. And so you just be careful. Now, could China continue to move higher? Absolutely. Are there levels that you can manage risk with? That's a little bit harder.
Yeah.
But they're there if you look underneath the surface, or you use parameters that might not be FXI, other tools that you might be able to take advantage. But bigger picture, how risk off is it if Chinese high risk stocks are moving higher? And it's not. It's just another box. It's another box being checked of risk on behavior. You're buying Chinese tech stocks. Okay. You don't hide out there. That's not where you go when the world is ending.
No, I completely agree. I think you brought up a good chart yesterday, Dave, credit spreads.
Yeah. we could continue to see triple C credit spreads break down, which is a cooling off and easing of liquidity. It makes it easier for, I know you've done a lot of analysis on, let's just say, energy stocks in the United States. There are companies that take on debt to carry out their mandates. It's getting easier for them to access cash rather than harder. So you're seeing a risk on barometer. Triple C credit spreads continue to indicate risk on. So not a negative thing for sure. Where else are we seeing, outside of China, strength?
I think we're seeing, financials had a good week this week. Continue to, they're trying to put in a relative base as well. I mean, really, energy's had a good week.
And energy is one that's interesting when you consider where oil appears to be finding demand.
Yeah.
So if you look at oil, and we previously talked in previous episodes about this $65 to $67 level. We've responded there. Oil has moved higher. And what's some might find interesting is the dollar also moving higher. But what we need to remember, and it's really not all that far-fetched, is that for quite a while now, the dollar has been highly correlated to energy. And if you want a macro story on that, America has become one of the best energy producers on the planet. And for quite a few years under the previous administration in this country, it was a net exporter. I don't know if that's true currently, but if you think about the process of buying energy, buying natural gas, liquefied natural gas, buying oil, if you're going to that market, you have to buy the currency of what that's in first in order to purchase that thing. So do we really get to be surprised of an environment where the dollar's moving higher and energy's moving higher? We don't, because they're highly correlated right now. And that correlation can change, can absolutely change. But when you see a trade-weighted dollar moving higher, you typically are also seeing energy move higher. And we might be getting both of those things. And some might say, well, that's negative for equities. Well, it depends on equity. It depends on which stock we're talking about. It can be. But what does it tell us if there's some strength in energy, strength in emerging markets with a strong dollar?
And you had strength in gold with a strong dollar.
Yeah. That's information. We're sitting up and taking notice and saying, oh, okay, there's a broad
back to 102. I mean, we just cannot break. We cannot break 100 on this thing. We've been going at it for 2.5 years. 1, 2, 3, 4, 5, 6, 7, 8. 9 attempts. 2 years. A lot of those here in the last 6 weeks.
I know you did a good job highlighting this week. We talked about China, but we also talked about Germany. What are we seeing out of the DAX?
Very strong.
And again, it's another one on a relative basis. Nothing to write to grandma about, but on an absolute basis and highly correlated moving higher, that's information that DAX is recording all-time highs.
Looks great, likely not going to outperform the S&P. So use those 2 data points to come to a conclusion.
Yeah, that's the way we think about it. Absolutely right. Is it nice that the DAX is in an absolute uptrend? It is. Is it a place where you can be? On a relative basis, not so much. It becomes an opportunity cost. That's why model makeup or portfolio makeup is important. Yeah, you could own the DAX, but you're better off owning the S&P 500 at this point. And that'll change. There will be a decade where that changes. I don't know when, but there will be a day where Connor is talking about the German DAX or international stocks.
So to our German friends and investors, I would like to say congratulations, or as they say in the native tongue, Glückwunsch.
Ooh, okay. I like it.
I didn't know that. I had to go to Google Translate real quick.
Google Translate's nice. It helps.
Glückwunsch. Congratulations, Germany. You're an all-time high.
That's great. Again, all-time highs are not a characteristic of bear markets, but they are a characteristic of bull markets. So we have things like seeing demand. We're seeing the dollar move higher along with energy. We have technology sitting in the hip pocket. What I mean by that is if your team is having success with Pat Mahomes on the bench and Pat Mahomes has a chance to come back in the game, how much happier are you as a fan? Same thing with the market. If your leaders have been on the bench and the team continues to do well, that's tremendous. That's a tremendous backdrop. And when you have weight S&P, equal weight NASDAQ, you even have equal weight Russell 1000 at new highs, that is bull market behavior, despite the narratives of our day.
Yeah, and then beginning of July, Apple is actually slightly negative. You got the S&P up over 3%. You say even with 3 months. I mean, hey, 3 months, 3%. Annualize that to what, 12? That's above average. You know, above average, period for the market. And the most important, and basically Pat Mahomes didn't play a single snap.
It's amazing.
And the team won the game.
Yep.
I'm not saying that they won 49-0. Team won the game.
Yep. So it's a quality characteristic to see things like energy. I mean, even biotech, right? There's all sorts of tech going on. Biotech showing some resiliency here, especially if we look at something like you highlighted on the team this week, ARQ, right? The Kathy narrative has definitely died down. She was the piñata for months on end. I get why, but I haven't heard anything on that in a while. And here we are with ARQ above a really important near 60 on a base that's been 2.5 years in the making, also risk on. Are we really hiding out in biotech stocks? Things are bad? Probably not.
What about retail stocks?
Yes. Yeah.
And your Costco's, your Walmart, and see, here's the thing. This doesn't include Amazon. Amazon hasn't done anything since we're going on 6 months. Flat Amazon.
Yep.
Your Home Depots, your Lowe's. It's healthy. And now you got, I think JD is in RTH.
Okay.
So that's your big China name that's now come. That's at a huge move. Almost up 100% from 25 to 45. It's just, and you haven't seen, I will say one relationship I kind of am still waiting on is the high beta versus.
Yeah, I thought you would go there.
Low vol, but it's holding in there. And where is that? We talk about this a lot, Dave. It is nice to look at these relationships for clues. You still got to default to, I'm not hanging out in cash because I don't like the high beta, low vol relationship.
Right. Yep. You can't do that. Not when you have a way to measure trend in two ways, and they're both confirming, which is one, looking at price levels, higher highs and higher lows, and you have a rising 200-day moving average. That means demand has control of this market. And that doesn't mean October can't have its correction. Is notorious for having pullbacks. We can definitely have that. Now, will people use that as an opportunity to do their homework and look where the strength is if and when that happens? Typically not, because people are lazy. That goes back to what we talked about in March, which is it's a BTFD environment until further notice.
It is.
So with that, I want to highlight the supporter of this podcast, the Adaptive Select ETF, which is listed on the NYSE under ticker ADPV. Helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. Since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. You can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Where else we want to highlight for our listeners? What other areas? We touched on the dollar. We touched on China. We talked about equal weight stocks.
What about where are we at with like the precious metal stuff?
Yeah, I think you said it well last week or even the last several weeks that when you look at precious metal by itself, whether it's gold or silver, their uptrends are great. When you look at them on a relative basis versus S&P, they remain in a range. It's a battle there as far as whether that's an opportunity cost or an opportunity advantage. And I think the same can be said for gold miners. But I will say that it's notable, as you alluded to before, to see gold move higher while the dollar is strong. And to see...
And we've got silver making all-time highs today.
Yeah.
SLV is.
Yes. Yeah. Even futures are making new cycle highs. They're not
cycle highs. Okay. Yeah. I didn't zoom back enough.
Yeah. They're not breaking the August highs, but if gold did it first, August 2011 highs, if gold did it first, there's always a period of time where when precious metals are doing well, you typically see silver do better than gold, and you typically see silver miners do better than gold miners. And then this isn't a precious metal, but it's an industrial metal. Seeing what copper and copper miners are doing recently, also risk on type behavior. I mean, copper futures are flirting with all-time highs. Go back
on the back. I'm sure on a lot of this on the back of the China, but as the chart, it makes sense. I mean,
and when you look at something like COPX versus S&P, it's in a range that goes back to the beginning of 2021. If this range breaks to the upside, I mean, that's game on. That is cyclically, economically important metal. And if it's
globally, you're going to get a nice, when's the last time we had a big push in copper? 03 to 07?
And that's
we've had other big, obviously 2020, the rebound in 09, 010, 10. But but those didn't change the range.
Correct. And that's when you saw outperform, when copper was outperforming.
Yeah, industrials. Golly, you even had utilities outperform for like 3 or 4 years. And we were in a bull market. Another thing I want to bring up that I think is very important to hammer home on why you follow charts versus, I won't even put it in the narrative category because it did happen. We did get a rate cut. And what happened to rates directly after? Started moving right back up.
Yep.
Bonds sitting at 1 month lows, especially the further you go out on the duration. I look at a TLT. We are back to where we were late July. I know that when you hear rate cut, you think that bonds will go higher. It's not really how it works in the short term. So we'll see how this continues to play out, but they cut. I mean, just God, when you're a technician and you can look at the chart and see where all this lined up, it's really not shocking.
No, it's not. There's no surprise here.
And that's why there was never any move into long duration bonds. Well, and so again, on a relative basis here, they actually did, bonds did try to make a move, but on a relative basis, I mean, a couple more bad days, we're going to be a year at all-time relative lows.
Right.
And so to your point, Dave, what does that tell you about the S&P?
Strong, baby.
It's strong. They're not going to move into risk-off assets yet. So you say, well, here, you just talked about gold. Okay, we've moved into gold. But the demand for gold is not outpacing the demand for U.S. equities.
Correct. there's more demand, and there are periods of time, such as 2005 through 2008, where gold does outperform the S&P. So equities are moving higher, gold is moving higher, but gold is outpacing.
Yeah.
That could be a precursor to a risk off event. And we're just not seeing that. That's just not a thing. And I get it. I know there's a ton of different narratives that are out there. It's the election, assassination attempts for the Middle East.
Yeah, war in the Middle, hurricanes,
war in Ukraine, you name it, closure of ports, all these things. And the market is a beautiful mechanism for weighing information and is a discounting mechanism looking out 6 to 18 months. And right now, the market is pointing higher. And do we get to be surprised when, man, we're starting, like, some of these economic numbers that are coming in are surprising the upside? Well, the market's been forecasting that for a while. We don't get to be surprised by that.
And I think we've done a very good job of this in 2024, being bullish, at the same time recognizing we're not sitting here and saying that everything is hunky dory with the economy or the expenses of things. I always want to make sure we harp on that. Clients or other people who listen to this don't think we're getting on here and ignoring other issues going on in America or the world, what's happening at home. You and I say it every week. Everyone goes to the grocery store. It's impossible not to notice. But again, the market is not necessarily the economy, I would say, outside of like the extremes. And so I just don't want people to be frustrated. We've been bullish on equities for a very long, really coming up on a year now. But I don't want to, what's the best word here? Make it seem like everything is just grand in the world. But it's another point that got to follow the market trend and not headlines or the other things that you're fretting about in your life. I know there's a very long-winded way of saying that, but
yeah, the market doesn't care what we think.
And I see a lot of comments out there of like, how can you? And I've got I literally have friends who are like, how can you be positive on the stock market? And the answer of, well, we're above 4,800 is simplistically, it's not really enough for 90. Like, it's not enough for people.
Yeah, it's hard to.
There's no depth in that. There is no depth in that answer.
People enjoy complex explanations.
Yeah. Why, Ian? Because it's a line I drew on a digital chart on my computer. That's why.
It's simply all the visualization. All these charts are the visualization of supply and demand. And what we know as law, right? This is not an opinion, that when there's more demand than supply, price moves higher. And we just saw equal weight tech, equal weight S&P, equal weight Russell 1000 have enough demand to push it above prior highs where sellers had been and move prices higher. QQ, EW, EQAL, basically 0% return for 3 years.
How can you call that a raging bull market?
Correct. It's not. And you have things setting up again and things happening underneath the surface, such as the largest energy companies in the world, like ExxonMobil, living in a range, going out to brand new all-time highs. So ExxonMobil, brand new all-time highs on a weekly and daily and monthly closing basis, and is sitting only 30% higher than it was in January of. So
wow.
in
16 years,
percent return.
Like 1.5, like 1.5 a year. Probably.
If you did it that way, yeah. It's RSI, measurement of momentum in a bullish range, going out to new highs. Like, how bad are things economically if the largest energy company, one of the largest energy companies in the world, is breaking out to new highs. And I'm not saying that it's an opportunity advantage versus S&P, but it might be. This is what it might start to look like. If we look at that relationship, and if we're above prior lows that we just had near 0.02 in that relationship, you could easily see this start to move higher.
How can you look at a chart like ExxonMobil and I'll preface this, I mean, we could be on here in 2 weeks and be like, yeah, ExxonMobil stuff, that was a failed breakout. We got to change our opinion on some things. But yeah, it's a big one. I put it up there with the JP Morgan.
Yep.
It's an important, thing that you want to see going in the right direction.
For sure. And so we have all this evidence upon us that continues to point to, yes, we could see near-term correction in October, but you're heading into the best 6-month window of a 12-month period in November through April, and especially so after election, regardless of who gets elected. I mean, I know we all have our favorite candidate. I know who mine is. That's an easy vote. But regardless if that person wins or loses, the November through April period after election is substantially stronger, seasonality speaking, than the November through April, which is already strong in any other year. And so you're telling me that if October is weak, that it's all over? Now, it could be, but use price levels. If we're below a 200-day moving average, the support of this podcast, the Adapt to Select ETF, uses tools like that to identify when risk is higher than it is right now. And
if those guys are trend followers, they know when to get out.
Right. You will never be out at the top and you will never be in at the bottom. Trend following is being part of the trend, hopping in the boat when the river's moving fast, and when the river moves against you, getting out of the boat. But it's never
capitalizing on that 90% that you can.
And here we are. We're still only 11 months removed from the breadth thrusts that we saw in November of last year. We're only a few months removed from the breadth thrusts we saw in July, and we're still sitting at a quality position on where breadth is right now. We have advanced decline line going out to new highs. We have the bullish percent sitting at midfield. We're not talking about a bullish percent that's sitting in the 80s or 90s when correlations start to go to 1 and you start to see stocks fall off. We're not there yet.
Okay. So, oh my gosh, thank you so much for bringing that up. So you said 11 months, right?
Right.
The breadth thrust, the early November breadth thrust. And so, and I should go back and find some. I'm zeroed out. I can go back to Dietrich. But so, and we touch on this from time to time. So at that, think of all the data points that were coming out at that time. Oh, if this holds, let's look at stocks 12 months later. And you look at the numbers and you're like, holy cow, that's awesome and way above average. And here we are, 12 months later, S&P's up 32% since then, NASDAQ's up 30, small caps up 29. And you're like, holy cow, that was way above average. And you're like, well, yeah, that's what the data said last November should happen.
Yeah, it's a great point.
It's hey, you better participate. I'm sorry if things politically aren't going the way you want or, whatever, but you gotta, this is what's happened for 100 plus years, 150 years, stock markets, and open the doors of the stock market.
The market does not care about the narrative of the day. It's the other way around. The wet streets don't cause rain. The market moves first and then there's a narrative. We could be looking 6 to 12 months out from now, and China's even higher than it is now. And there's going to be a narrative that's built around that. You could see the stock market lower. You could see the S&P 500, a 200-day moving average. You could see it below 5,600. You could see it below the lows over summer. And then we could start talking about the trend changing. And then there will be a narrative around that. But the market moves first. And we continue to see the leaders lead, things like NVIDIA compressing. So price getting tighter and tighter. And you've got after a substantial move. And that'll be one to keep an eye on. If NVIDIA, if the leader in this market is below its summer lows in August, then we maybe have to revisit the downward thesis. But if we're going to here and move higher, consolidation's typically resolved in the direction of the trend. And let's say it does initially resolve that way and then flips the other way. That's also information.
Yeah.
So all we have to do is study price and not overcomplicate things. Life is complicated enough the way it is. Why make it harder by studying data points often get revised
or that you tuning into conference calls.
Right.
Or reading someone else's opinion on Seeking Alpha about some stock.
Just use supply and demand. Keep it simple. It's the simplest way.
And I say that because I've done it. I don't say that to be a hater. I say that because I've done that. I've looked up, little biotech stocks with cutting edge, drugs that are in phase 2 trials. And
right.
It is long term. It is worth it.
That's right. And nobody has a crystal ball. Nobody has future information. All I know is that price is the closest to the future that you can get, which is the current. All these other data points are from the past. Price, when taken in aggregate as a Bayesian and aggregated that way, we have an understanding of what the market dynamics are currently. And while the bullish thesis is intact, what studying supply and demand does is it allows you to understand when that thesis is wrong. And I wish I had that in other aspects of my life. In relationships, it would be great to have technical analysis to understand I'm not hearing things correctly, when I'm not understanding information at hand. And sometimes we don't have that. But
are you trying to say you want TA for your wife?
Maybe.
Yeah. You can see where she's on the chart.
Yeah.
Oh, we had a breakdown today. So I'm going to be pretty chill when I walk through the door and I get.
Yes, correct. Exactly. Like if we could keep things a little bit more simple and understand that the power of technical analysis is it doesn't predict the future. It just gives you the information on odds, which are right now are higher highs and higher lows, and also gives you information on when that thesis is wrong. And here we have a simple tool like a 200-day moving average on something like the S&P 500. If you use S&P 500 cash, that 200-day moving average is currently at 5250. So you can use that as a tool to understand, does demand start taking more control of this market? And we're just not there yet. We're just not. And I hate to break it to people. It's not any more sexy than that. I know there's sexier narratives out there. I get it. And I know there's personal experiences that drive our opinions on the market. You could be having a bad day, week, month, year because of what's going on at work, what's going on in your relationships, and that manifests itself on your opinion on what's going on in the market because some people tie the market to the economy when that's not the case. It's a future discounting mechanism. It's actually working in advance of the economy. We just have to be careful as investors not to consume things that are on TV, things that are on social media that warp our perceptions and create all sorts of noise in our lives. Just focus on the signal. Focus on the signal, avoid the noise, be involved with markets until the thesis breaks.
And money and investing is such a high emotion, touchy subject as it is. And I think that goes back to how can you just check in on a chart a couple times a day to decide if you're going to do anything. That right. is astronomically sensitive, simple. You're sitting there saying, Ian, like I could train a monkey to do that. Yes. I am not gonna disagree. You could train a monkey to do that. 95% people just don't have are not willing to make it that and this sounds weird, but it's gotta be more for people. It's gotta be more complex. There's gotta be something more than line go up, line go down. Like you're a caveman and you're just drawing hieroglyphics.
So let's not overcomplicate it. Let's keep it simple. So with that, Ian, bumping up against the end of our time, anything else you want to highlight before we wrap it up?
I don't have anything to wrap up.
All right. Awesome. Well, we appreciate everybody listening. If you appreciate that information, please share it with others. Give us a high ranking. That's a compliment to us, and we really appreciate it. Thanks for being on here with me.
Have a great weekend, everyone.